Here's a video outlining what my stock research app does. So if you're looking for a phenomenal piece of software, head over to leodileo.com to get this amazing tool. So this software is used to research any stock you would like. So we're going to go and load up Apple here and click search using the ticker symbol AAPL. And what this software is going to do is going to load up everything you need to know about Apple. And this software here, folks, is primarily just only on a desktop platform as of now, but we are working diligently to get this on a mobile platform so you can have it on your phone and on the go. So we put in our ticker symbol, we load up Apple, and here is the main page, the Stockspect page of the software. And so what's going on here, folks, is that it's giving me the profile of this company. So from here, I can see the chart of Apple from a full year, from actually a 10-year perspective of this business, and I can zoom in as much as I like to get a closer look at how this company's been over, let's say, a period of time. So I can go, let's say, from 2021 to February 2022, however I want, as well as it tells me the main information on the company, the market cap, the sector, the industry, everything that you can read out here, the exchange and country, and so on and so forth. And you've seen, if you watch any of my other videos, I've talked about this section about a bit. This is the company metrics category. And what the company metrics category looks at, it looks at the performance of the 5-year averages of the business on the right-hand side, and the trailing 12 months on the left-hand side. So with this section here, you can use this as a comparative tool to compare how well the company has been performing over the last 5 years. And everything's almost on a 5-year basis, folks. So with Apple, you can take a look and see that with the PE ratio, currently it's at 22.73, and on average, the PE ratio has been at 23.49. Where this gets interesting is now that we have the trailing 12 months and the 5-year average, we can see how that compares with, let's say, with the EPS, so the earnings per share. Earnings per share is currently sitting at 6.09 compared to our 5-year average sitting at 3.46. So with this information, you can see that, okay, with a similar PE ratio, Apple's EPS has increased by a substantial amount, pretty much doubled. So you can instantly see the improvements here. So ROE stands for return on equity, and you can see that over the last 5 years, so on average, it's been 78%, and currently it's 152% return on equity. So this tablet or this table here is used to compare what the company has been doing on average to what it's currently doing right now as it's being reported. So you can see with that, with the profit margin, so on and so forth. Now on the bottom half of the company metrics, you get to see a lot of other information as well. Same thing with the free cash flow. You can compare the 5-year average free cash flow with the current trailing 12 months free cash flow. And I've put the dividends paid. If the company pays out a dividend, you can see that and contrast and compare that to the 5-year average free cash flow, because this is important, folks. When you're paying out a dividend, or when any company pays out a dividend, that dividend is being paid out from the free cash flow. So if we know, let's say for Apple as an example, it's 0.64 of a yield, and it currently pays out $14.5 billion, and our average free cash flow is $68 billion, we know that Apple can easily pay out that dividend, no problem. And contrast and compare that to our free cash flow in the trailing 12 months, they can easily cover that. So you have an idea, because there might be some companies that have a lower free cash flow in the trailing 12 months, or not enough cash on average to cover their dividends. So these are all little different tools that you can use to compare and contrast with the companies that you are researching. So keep in mind, folks, this is a software that investigates one company at a time. This is a sniper. It's a one-stop shop to look at a company in detail. So if you have a list of companies that you want to research and you want to go through them thoroughly, this is the software for you. Allman Z-score is a score that grades the company based off of its bankruptcy, and basically any number above 3 means that the company is safe. Any number below 1.8 means that the company is in distress, and 1.8 to 3, it's a gray zone. So you can use that metric as you will. In case you don't know what Altman Z-score is, Piotrowski score is a score developed by an accountant, Piotrowski, and basically contrasts and compares year-to-year improvements out of a score of 9. I don't remember what all the 9 categories are. I can't list them off the top of my head, but like some of them deal with return on assets and stuff, and different assets and liabilities if those are improving year to year. And the company gets a point if improvements have been made. So in the case of Apple, we have 8 out of 10, or 8 out of 9, sorry. So that's an extremely high score. So that's good to see that. So with this first category done, this is how you use the company metrics category. It's just a simple, you can look side to side and see whether the improvements have been made or not. And PE ratio is a great indicator to start with, because if you have a high or low PE ratio and you're seeing everything else rise, well, you're seeing a lot of improvements within that business. So that's first the company metrics category. Now, you can jump over to the financial evaluations category, which I've talked about a bunch in my videos if you haven't watched my videos yet. And here, we simply rank the company out of 10. And what this section does, it takes a look at the balance sheets, the income statements, as well as the cash flow statements, and provides us a score based off certain metrics. And basically, you can see it written out here, whether the company is earning a point, basically a 1, or not getting a point, basically a 0, based off of the fact of if they are hitting a certain criteria. So with Apple, on average, they're not earning a point for their PE ratio because it has a high PE ratio. We want to see this number below 22.5. So if it is below 22.5, it would get a 1, basically a point, and so on and so forth. So basically, if the company hits certain metrics, it would be rewarded a point. So with current ratio, we would see a point if it's awarded 1.5 or higher, meaning that they have enough assets on hand to cover their liabilities, so on and so forth. And you can see that it awards points for things that it is doing right. And that's simply the financial evaluations. Now this tool here, these 10 categories are a phenomenal starting point to see whether you would be interested in a company. That's why I put it right below the chart here, because you can see how the price has been affected, what is the score of the business, and sometimes, you might just be an investor that only wants to buy companies that are 7 and up, or 8 and up, or maybe you just want companies that are a full 10 out of 10. Obviously, those are very hard to find. They're unicorns, but sometimes you want to just go based off the score. And Apple's it's a solid company for these reasons that you can see here, all clearly written out for you. And you might just go based off this category and then use that in conjunction with the company metrics to see this is the score that the company has. How is it contrasting and comparing deeper with the 5-year averages that it's been showing to what they're currently doing? So these are 2 different tools that work hand in hand to kind of give you a more deeper insight for how the company has been performing. Scrolling down even further, this is probably the most intricate part of my software. This is the part where I think a lot of people want some clarification on how to use. This is the price analysis section. So this section here is where my software pretty much began. And I wanted to make an intrinsic value calculator to help me find what companies what is the intrinsic value of different companies and how they should be priced out. So with this analysis here, you can do up to 3 different assumptions, and we'll get into that in a second, over up to 1 to 20 years of outlook. So basically what this will do is whatever values you put in these boxes, it will forecast those values over the next 10 years and then discount them back to what today's value would be. So with Apple, or with any company for that matter, you would put in revenue. You would start with the revenue percentage growth. So with the 3 categories, and we could just do 1 for now just to show you what that looks like. So with the historic numbers to our right of us, we see 1 year, 5 year, and 10 year. And you can see how the revenue's been growing over those numerics. So we can make an assumption, and this goes based off your own assumptions, folks. And if you watched my channel before, and I'll say this time and time again, I like to try to stay as conservative as possible. So if I see over the 10 years, it's gone up. So let's say with 5-year revenue growth, right? It's gone up 11%, right? And then on average, it's gone up 10% over the last 10 years and 33% over 1 year. I typically will stay away from the 1 year number, and typically I will pretty much stay within any numbers between 5 and 10 years. And just for my own basis, I like to stay between numbers that are ideally lower than the 10-year number, or any number for that matter that is the lowest on the board. So for this example, the 10-year number is 10.58%. So for me, if I do revenue growth with 7, 8, and 9, right? Because I believe that this is year to year, folks. So keep this in mind, year to year. I believe the revenue growth is going to grow 7%. So we'll just do. This is just an example for just one. If I believe it's going to grow 7% a year, in my conservative assumptions, that's every year 7%. The revenue is going to go up. Moderate every year, it's going to go up 8% a year, and aggressive every year, it's going to go up 9% a year. So for the sake of just this one example, we're only just going to put the one assumption in, being 8, but you can do 3 different ones depending on how you see this company growing, right? I like doing 3, but for this example, we'll do 1. Profit margin, same thing. We see that the profit margin on average has been, let's say, 22.5% on a 10-year basis, 22.31 on a 5-year basis, and 25.88 on a 1-year basis. So if I think that, you know what, 22 seems to be the average here on a 5-year basis, I might just do 20%, give them a little bit of a haircut. And the reason why I'm doing 20% is because every discount that I give the company going forward in this assumption box is what is my margin of safety. And I've said this time and time again that if I'm wrong on my numbers and they do better than what I put into these boxes, that works out in my favor, right? That works out in my favor because then afterwards I'm able to find companies that are going to be trading at a fairer discount. That's what's the most important thing. So putting 8% revenue growth, putting 20% profit margin, which is lower than what we currently have, because they very well can do more than 20. And then going forward, if I could put, for my free cash flow, I could put 20. But granted, folks, you can put any number you want. You could put any number you want. If you believe that Apple will do 40% revenue growth, or sorry, 40% in free cash flow margin, put it in there. This is up to you, the user of the software, and you can put it up as you can put any number you wish. But for me, and as a reference point, this is why I included the historic numbers to the right, that you can utilize these numbers to give yourself a more realistic expectation for this business. You might even say, you know what, because, and here's a hypothetical scenario, because of the market cap of Apple, and it's $2.25 trillion, you don't believe that the revenue growth is going to be that high. You think it's going to only grow 5% a year. You may also think, hey, there's a new competitor on the block, so I don't think the profit margin is going to be that high. I think they're going to lose business. You can put in here, folks, whatever your heart desires. These numbers to the right of you is just a ballpark of where you could potentially use from a historic basis, and I like to use these numbers plus a haircut on them to give myself a fair evaluation. Now, the price to free cash flow, now it doesn't quite line up with these boxes here, but this is for the price to free cash flow box. And ideally, we want to keep this number underneath 20. You could put higher numbers, but like the PE ratio, folks, we want to find companies that are trading with a fairer price to free cash flow. So with price to free cash flow, anything below 22.5, typically I like to just stay underneath 20. That is my ballpark. So with price to free cash flow, let's say if I just do 20, and with the PE ratio, as we currently see, it is at 22.73. I can say, let's say we put it at an 18 PE ratio. So that would assume Apple being at an 18 PE ratio. And finally, last but not least, our desired return. So how much do we want to see a desired return on our money year over year? And that would be 13%. So the market on average returns 10% a year, right? So when you are investing into, let's say, individual stocks, you know what, risk a little bit more and put a higher desired return. Now you can put this number to be whatever you like. If I don't want it to be 13, I could put 15. I could be astronomically high and say I want a 50% return. And ultimately, this is going to decrease the price that you'd have to pay for the company, and we'll show you that in a quick second, by that amount. So let's say we do 13%, as I always do in all my videos, and I click calculate. This software is going to run the numbers. The current price of Apple is $140.09. So what the software is going to do is going to run all the different calculations, and it's going to spit out our average calculation. So, folks, the average calculation for Apple would be $64. Now, what does this price mean? This price means that based off these numerics here, because we did a 10-year evaluation, that you would have to pay $64 today to assume a 13% return for the next 10 years for Apple to be at a fair value. Does that make sense? Write down in the comment section down below if it doesn't, and if you're watching this video on my app channel, you can send me a DM. But this is what the software means. $64 is what you would have to pay for the business today, assuming these revenue growth numbers and desired return for you to make your desired return. So that's how the software works. And if I put a higher desired return, you'll notice this happens. So it's going to run through the calculations again. It's going to calculate now with the higher desired return. It will decrease the price as such, because now you're asking for a higher percentage return on your money, on your capital. So then you'd have to pay a lower price for this company. So this tool is inherently important for value investors, and the majority of people that watch my channel are value investors, because we want to find great businesses at fair prices. So for this scenario here, $60 would be the proper price to pay, or $61 for Apple on average, to get our 15% return. So that is the price analysis section of the app. And write down if you have any questions about how this software works. But basically, that is the Stockspect page, the main page. You have the 3 different sections that you can use to contrast and compare the business on how well it's performing. On the top half here, the financial valuations, which probably majority of investors will use to grade the company. And you can just simply buy the company based off of this score alone, and if it matches up well with what you see over here, this will show you that if you have a strong business or not. But if you want to use the full content, if you want to use the full scope of this app, using the price analysis section, you can figure out what you should be paying as a fair price for this company, so you avoid overpaying for this stock. And then as you scroll down even further, we have the company info, which just provides you the description of what the business does and what they offer as a service, as well as the most updated news channels coming in. And you can see at the time of recording this video, today is October 8th. So these are all articles that have been posted today, and you can click these articles to have a better understanding of what the company does if you need to do further research. So that is the Stockspect page. Now, going forward, you have access to the income statements. You have access to the cash flow statements, as well as the balance sheets. Nothing much to say here, folks, but you can sort them out from an annual or quarterly basis. So we can go annual, and we can see based off of those 3 sheets there, how the company has been performing. If you want to get more of a investigative look on this business if you don't want to use just the Stockspect page. So we have that. It's completely up to date, as well as the SEC filings, SEC filings down below. You can follow those links for all that information right there. So you can see everything perfectly and clearly outlined, as well as our last section here, charts. So the charts section will be updated. For now, we have a few charts to show you folks. So if you want to see things more visually, you can see the revenue, the net income, and the free cash flow all laid out for you. And you can see how well the company's been performing over the last 10 years. So you have a better idea of how this company's been performing, as well as a contrasting comparing chart of the free cash flow per share versus the earnings per share. And ideally with this, folks, you want to see companies have their earnings per share and free cash flow per share run parallel with one another. And it is phenomenal to see that with Apple. So that's an example there. Shares outstanding, you see how many shares have been outstanding over the last 10 years as well. You can see that Apple's been buying back shares, which is great. You can see their total assets versus liabilities and contrast and compare that, as well as the performance against SPY. So you can see how well Apple's been doing against SPY year over year, as well as the top 10 institutional holders. So you can see who actually has a piece of the pie of this business. So there you have it, folks. This is the Stock Research app, and I've built this app specifically for new investors and value investors alike to have a tool that's a one-stop shop so you can understand what you are actually purchasing. Majority of users will definitely use the Stockspect page, as this provides you with a quick look at the company, and we have companies on every market from US to Canadian on the Toronto Stock Exchange, as well as Euronext markets. You can just search up another company and we'll pull it up here, and you can do the same process over and over and over again. But the main tools that you will be using, as I said, are on this Stockspect page. The company metrics to take a look at the 5-year averages to the trailing 12 months, the financial valuations, which grades the company, as well as the price analysis section, where you can use to price out this business and forecast what you believe the company is going to do. And like I said, folks, this is a crucial part of the software, and I would recommend personally using rational numbers. Use the historic numbers section as a ballpark of where you should be lying, but feel free to put any numbers you like in here. But remember, folks, this is what will affect your price overall, and if you believe these numbers. Because if you just put astronomically high numbers, let's say if you put, let's say 19% revenue growth, right? If you believe these numbers, are you really truly being rational with yourself? So my recommendation is put numbers that you believe to be rational by using the historic numbers as a ballpark, and then afterwards the software will do the rest, and it will tell you what you should be paying on average. And you have, as I said, 3 different assumptions. So, and if you've seen my videos before, if I am doing a company like Apple, and let's say I did 8% revenue growth for my moderate, I might do 7% on the conservative and 9% revenue growth on the aggressive side. And what that means is now I can put lower numbers on the conservative side because I want to be conservative, more moderate in the middle, and then aggressive because obviously 9% revenue growth is much more stronger than a 7% revenue growth company, right? So folks, that is the video on how to use the Stock Research app. And if you're looking to sign up for this amazing piece of software, as I said, leodaleo.com is where to get that, along with a more exclusive content for those that are signing up. We have a community page also coming, so look out for that, folks. Anyways, that is the Stock Research app. Hope to see you guys sign up and join the community. Anyways, folks, thank you so much for watching.